This event has been labeled the Future of Cities series, which is indicative of this is the first of what will hopefully be several more series in a plan of series here. Originally, Brittany Bagent was going to join. She unfortunately had a last-minute conflict that she couldn't get out of, and so she will be joining in the future and has a lot of insight coming out of the governor's task force where she led the staffing effort of that, and certainly that will be the topic of conversation in one or more of the upcoming sessions. But I think today this is largely meant to be a recap of the State of the Economy report, which we do every year with the Portland Metro Chamber and released here a couple of weeks ago. So for those of you who have seen that presentation, this will be largely a recap of that with some content on the front here, specifically talking about the future of cities. So if you enjoyed it and want to watch that presentation again, feel free to stick around. If not, that is what we'll be talking largely about today. So with that, I think just diving in here, cities are the topic of a lot of conversation today. And I think this is a quote that gets regularly used, and we're talking about urban economics, which is cities have always been the fireplaces of civilization from which the light and heat radiated into the dark. And what we hear a lot about today is this evolution of cities as if this is a new phenomenon, that cities haven't ever changed. I think what we see when you look at urban economics textbooks or take class and look at theory, like cities formed for a reason. And ever since then, they have all been continuously evolving. And certainly this rate of change is different. I don't like using the word unprecedented, but different, quicker, more rapid. But that also is very typical, in that you have large periods of kind of steady state, and then we have a paradigm shift or a big disruption, and that big disruption leads to change. And we're certainly in and amongst those changes today, largely fueled by the pandemic and the change in behavior that resulted during the pandemic and its recovery. And I think if we start to think about why cities matter, again, that will be the topic of future conversations. But to me, the simple answer is agglomeration. And agglomeration is a fancy word that economists use that describe the benefits associated with proximity. And this has always been kind of studied and quantified, et cetera. I think the question today is, do these things still hold true? That is to say, do we get benefits from matching? So are we able to recruit from a deeper pool of workers with skills who are all in and around proximate to each other? Are we able to share, that is to say, efficiently use inputs, supply chain, and infrastructure efficiently in the same way that we always have? And is that learning, which historically has been done in person, today certainly done more in a hybrid environment, is that knowledge spillover effect still the benefit of cities? And I think the answer is, in a classic economics frame, it depends. Some things certainly I think are the same as before, maybe others to a lesser degree. But that's the framework I think we can look at in terms of how we're trying to understand what is going on around us. And one of the most talked about, publicized in the media, I think, concerns today is places that have been office-centric aren't particularly well positioned, at least as the narrative, for future success in terms of largely measured today through foot traffic and return to foot traffic, which is to say, you can measure how many people are in and around an area today using cell phones. And what we see is, compared to pre-pandemic, the places that have more of their workers in offices have had less of a recovery. And Portland is certainly at that tail end in terms of highest concentration of workers in the geographies that were defined. So this study is Downtown Recovery. It's a joint effort from University of Toronto and Cal Berkeley. And they study 63 cities across North America every so many months and basically look at what share of foot traffic has returned relative to pre-pandemic. And they find many headwinds, one of which is office. I think what that then leads to is this question that everyone talks about, is the new normal, as if that's something that's easy to define, and it certainly is not. I think what we want to continue to explore, and lots of people are looking into this, and there's new research being released every day, is, what is the future of hybrid work? How stable is that? Is that industry specific? Is that changing? Is that not changing? our downtown's dead. And I think here I use the word downtown intentionally because everyone says downtown, but I think as we get into the presentation today, we'll see more about central cities as larger areas, of which downtowns are subsets of those central cities. A question we heard regularly early in the pandemic was, everyone's moving to Zoom towns in the suburbs, largely from an affordability standpoint because they never have to go back to the office again. Well, how much of that did happen and how much of that is continuing to happen? And then I think just some basic urban economics kind of themes that are really relevant today as do people still value being close to the office? So I think the logic goes, if you don't have to be in the office at all or infrequently, does that mean you no longer desire to be near the office? Public transportation as a mode of transportation to the office in places like Portland had been amongst the highest in the country. Do people no longer desire public transportation? And from a walkability mix of use standpoint, do people still value being close to amenities and other proximity in terms of work and other things? So those are the big questions. I think there's a lot of assumption, hard to quantify these things, but I think for me, a lot of this has been overblown. And what we can look to are recent surveys. And so this particular one is done by the National Association of Realtors. I think it was in late last year. It's a comprehensive national study looking across age and location and asking basic questions like, do you still value being within a short distance commute to work? And historically, right, 74% of people said yes. It's very important, somewhat important distinction, maybe matters a little bit, but what you see is, early in the pandemic in July, people's behaviors maybe started or preferences started changing slightly, but really we bounced back to right where we had been previously. And so I think, at least from this survey, the notion that people no longer value that is not in alignment with what we're seeing in terms of preference. Ridership in public transportation certainly has decreased from where it was pre-pandemic. The question I think is, in the long term, do people still value having proximity to public transportation? And the answer is actually, according to this survey, more so than they had even pre-pandemic. So I think, again, these kind of narratives that you hear regularly when you look at survey data aren't necessarily in alignment with that. And I think the last one then is around how much people still value proximity to amenities. And so walkable communities is another way of saying that. And the answer is younger generations have more of a preference, but when this survey has been done over time, these preferences are kind of stable and or growing more towards that. And so this notion that certainly younger generations want to move to suburbs away from walkable amenities, we're not seeing in the data. So again, I think as we start to explore the future of cities, these are big questions that are important to answer. We have some early indications of that. I think what we're trying to do today is really start to look at Portland specifically and help contextualize what's happening in Portland as we think about other regions that might be appropriate peers, so we can kind of baseline what's going on here in terms of part of a broader analysis of the future of cities. So that was the quick intro section. As I mentioned, what we're going to move into now is largely a recap of the State of the Economy report, which we released a couple of weeks ago. That is available on the Portland Metro Chamber website, and we can certainly link to that in a follow-up email after this. But maybe quickly pause to see if there are any questions, reactions to the future of cities intro primer, and then we'll jump into what is largely a lot of data. I don't see anything in the Q&A. I don't have any hands unraised. Okay, let's go ahead and jump in here. So that is a dumpster. It is on fire, and that is where most of the conversation as it relates to the city of Portland specifically, and certainly the downtown and central city has been focused for the better part of a couple of years. This is the perception of the national media portrayal of Portland, and certainly we like to increase that negative reinforcement loop with local media and other perceptions piling on top of what is that national perception. I think the question as we got into this report, which we do every year, was if that was helpful contextualization at a certain point, is that still helpful? And I think the answer is we're saying we are sitting at a crossroads where we can continue to talk about what was the case several years ago and how we are or are not different to that. Or we can choose a path that says we have some agency here and let's contribute to a positive narrative and understand what can we do to regain Portland's prominence, adopt a more competitive mindset, and kind of help the regional economy to the extent that we can, rather than comparing it to things that are probably not that helpful. And so that theme, I think, is apparent in the report that you'll see in terms of what we're doing. And what we did is first establish new peer regions. And again, this is not specifically because of the current circumstance. As you'll see in a couple of slides, we historically look at new peer regions about every 5 years. So this is that, I think, very timely opportunity to say, how are we comparing to our peers? And the answer last year and the year before was we were performing dead last in pretty much every single comparison. And again, that's not to suggest that that's why we're changing peer regions. We'll talk about how we do that, but I think that's just helpful to understand that we were not performing particularly well. And so we start with the state of the Portland economy. We typically then compare to our peer regions. Today, I'm not going to put slides to that. I'll just summarize that in one statement. And then really it's a deeper dive into the state of downtown and the central city, where we can contextualize what's happening here in our central city relative to our peer regions, and then some larger framing questions and takeaways. And so I think context is important. That's why we can consistently look at our performance as a region. And again, our region here is the 4 counties. So it's the 3 Oregon counties, Multnomah, Clackamas, Washington, plus Clark County and Washington State. That is our metro region that we're looking at when we're contextualizing our performance relative to our peers. And so again, this is not city of Portland versus other places. We started doing this pretty much at the beginning of this report, which used to be called the Value of Jobs. That started in 2011, coming out of the depths of the global financial crisis and the Great Recession. And what we did was have these 2 categories of place. Peers, which were Sacramento, St. Louis, Cincinnati, and Salt Lake. And we had these aspirational regions. I think the connotation was our peers of kind of who we are, our aspirational regions are who we want to be. And I think over time, we realized that was not particularly helpful. And so what we did is continue to use Seattle as our regional peer. So they're always included in this analysis. But then we revisited this in 2017, and we revisited it by saying, who do we think we are today in terms of our region, and how do we best compare to other regions around the country? And so to do that, we take regions of similar size, so slightly smaller to slightly larger, of which there are about 55 metro regions around the country, falling in that, let's say, 2 to 4 million population. And then we look at a variety of characteristics in terms of industry composition, levels of affordability, educational attainment, race and ethnicity, a whole variety of housing affordability measures. And we basically then say, okay, rather than putting our personal bias on this, we can use machine learning algorithms to say, feeding in these variables, which things are most like each other. And when we did that in 2017, the answer was Austin, Nashville, Indianapolis, and Salt Lake City. And so those were our peer regions. And I think what we see now in hindsight was when we did this in 2017, we were kind of at the peak of Portland's growth cycle and had been steadily growing, but at a lower rate ever since 2017. And we saw that very clearly in the data as those peer regions continued to separate themselves from Portland on most measures. So what we did now is, again, replicate that same process and say, of the 50 or so metro regions that are like us in terms of size, who are most like us in terms of the composition of their economy. And again, Seattle, we always continue to push forward, even though the data doesn't suggest they're our peer. And what we found was that, surprisingly, I think a return to many of those previous regions that were both our peers and our aspirations. So Sacramento initially was our peer region. Minneapolis and Denver were our aspirational regions. And now Milwaukee is suggesting that the data group them in with us. And I think what's interesting is the paths we all took as regions from, let's say, 2010 to get to where we are today were very different. We had regions that were once aspirational, ones that were once peers that we exceeded. Today, we are in a very similar circumstance in terms of trajectory and composition. And I think as we look at some of the data, that starts to be pretty clear. What this, I think, as a hypothesis for us suggests is many of the regions are Midwest or Mountain West. And so when we look at the Rust Belt, for example, as a trajectory of place, are we looking at a postcard of our future, as what our President John DePona used to say for years? Is the Midwest this potential future reality for Oregon and the Portland Metro? And we'll return to that after we have a chance to look through the data. But I think that's the kind of highest level question that we started with as we got into this peer regions. And I think today the predominant question that we have is, what is the most salient issue for us and our peer regions? And the answer is population growth, and specifically related to migration. And so we have state level population data through 2023. Tomorrow, actually, census releases the county level data through 2023. So we only have through 2022. But what this suggests is that the state level census data showing that we have lost population in the last 2 years. And so these are the first time we've lost population in about 40 years, and only the fourth and fifth times since we have data. So since World War II that the state has ever lost population. So we've lost population 5 times, 2 of those were in the last 2 years. And I think what this is suggestive of is, again, a big deviation from that trend, which is consistent population growth. I think the state demographers, state economists in Portland State who do these forecasts are projecting that we're going to return to population growth, albeit at a lower rate than we have seen historically and what previous forecasts suggests. But I think, as our metro region, the chances that the state lost population in 2023, which again, we'll see tomorrow, losing population in the metro, not losing population, are very unlikely. So I think tomorrow when we see this data, we're likely to again see the metro lost population, and that would put the metro for 3 years in a row. And I think the question is that the pandemic? Is that the new normal? I think what we can see, and we've been tracking this for many years, is our peak population growth was in 2016. We continued to grow, but at a lesser rate. And so again, when we looked at the peer regions, this was the peak of the growth cycle, was 2016. We continued to grow. And then 2021, 2022, and likely 2023, we lost population. And I think what we've been exploring is 2 things. One, this is very different depending on which part of the region we're in. And 2, there are 2 components of population growth. One is natural change. So that is how many people are born every year versus die. And what we're moving to statewide, or have crossed into, is negative population growth that's natural. So that is to say, the demographic models all suggest that for the next 30 or 40 years, more people will die every year than are born in the state of Oregon. And Clackamas County has tipped into that. Multnomah County is very close. Washington County and Clark County do still have some natural growth, but that again is expected to continue to decrease. So what that suggests is we're entirely reliant on migration, both internationally and domestic, for our future growth as a state. So we're going to lose population through natural change. We need to offset that through migration, and any growth would be entirely based on migration. And what we see is migration trends in Clackamas County are 0. They're down the last 2 years extensively in Multnomah County, as well as Washington County. And so we see on the Oregon side, effectively, all of the counties are either shrinking. Multnomah and Washington are stagnant. Clackamas and Clark County is continuing to grow. And so from a regional perspective, this is very different than what we saw, say, in peak population growth times, where all of the places are growing. And we look at our peer regions, it's very atypical that some parts of regions are growing very quickly while others are declining. Typically, all regions kind of grow at a roughly similar rate, which is to say they're all growing, they're all stagnant, or they're all on the decline. And this is very atypical. In terms of why the big change, it's really the composition of where people are coming from versus where they're going. And so when we look at the data, we can see, within some geographic certainty around neighbor metros, are more people coming from those metros to the Portland region, or are they going? If they're coming, those are the green areas. So for us, historically, we have lost population to the rest of the state of Oregon as a metro. We've gained from the Willamette Valley, but we've lost to Central Oregon and to the coast. And that continues to be the case in the last couple of years. We also have historically lost population to the state of Washington, and that is continuing. And again, that's largely Clark County, but also other places. So those 2 losses, Clark County, Washington State, plus all of Oregon have typically been offset by California. And we continue to see strong in-migration from California in most places and the rest of the country. And so the rest of the country historically has been net positive into our region, and that changed 2 years ago. And the reason it changed is more people left the region to other parts of the country, not fewer people coming. So this is more suggestive of people choosing to leave the region than fewer people choosing to come to the region. I think when people are choosing to come to the region, they're increasingly choosing Clark County as their place of residence versus the 3 Oregon counties. And that's the big change that we're tracking and continuing to see in terms of, are people still moving to the region at the rates they historically have, yes or no? And are more people leaving? And if so, where are they going? So what this then suggests is, okay, is this only happening in Portland, or is this happening in other places? And when we look at our peer regions, we see almost the same pattern in all of these places, the notable exception being Milwaukee. And so in Milwaukee, they've had relatively stagnant population for the last decade or more. But really, Denver, Minneapolis, Sacramento, and Seattle, if you look at the peak migration in all of those places, was roughly 2015, 2016, 2017. And all of them began declining in terms of their population growth pre-pandemic, and it was all exacerbated in the pandemic. What we've seen, though, is a recovery post-pandemic in many of these places, Seattle being very notable, Minneapolis still seeing some negative population growth, for example, and Sacramento less of an impact. And so for us as a region, I think the question is, this is not atypical. We see this in many of our peer regions. And how does this impact our ability to compete for jobs, households, et cetera? And I think is an important contextualization versus saying this is only a Portland problem and no other places are facing decreased population. What is atypical in Portland is our natural change. And so all of these regions, the gray bars are natural change. And you can see, with the exception of Milwaukee, they're all pretty positive, which is to say they can counterbalance net migration losses through natural growth. And we don't have that option. And so for us, this is a very different challenge in that we're entirely reliant on migration, whereas other regions and our peers specifically have natural change. And so they're not entirely reliant on migration to grow. So let me pause there. I see there's a specific question here in the Q&A. How are people moving within the Portland metro since March 2020, movement from downtown to suburbs, for example? That's a good question. The data are a little bit challenging in that the best source of data for that with accuracy is the IRS tax records. So the IRS tax records give us a complete survey of everyone who's filing taxes, who's moving. And that data is only available through 2021. And again, later this month, we'll get 2022. It's always a year lagged beyond census. And so I think we'll have a better sense in that IRS data. When you get into some of the census data, it's really hard to track on an annual basis who's moving where at anything less than even the county level. We do see, though, increased migration into Clark County from the Oregon side. So that's the one thing we can see more definitively in the data. But in terms of, central city, Portland to the suburbs, for example, is a little bit harder to track. Any other questions on peer regions and kind of that top line population data before we hop into some of the specifics around the Portland central city and the state of the economy? Okay, another question. Can I describe how predictions for natural population growth are made? I can try my best. I'm not a demographer by training, but my general understanding of this is the state maintains age cohort-based modeling. So they can look out into the future and say, how many people of each age cohort are we expecting? And so over time, cohorts age, we can model that. We can model what we think in-migration and out-migration look like. And then they have assumptions around death rates and family formation and fertility rates. And what those models show effectively is, right, continuing aging population. And that aging population is going to increase death rates more than our population is going to increase our our fertility rates. We have both higher than usual aging populations and lower fertility rates than other places. So this isn't just a aging population only story or low birth rate story. In our instance, we have both. Again, this is not atypical. Many states have natural decline. We're at that leading edge of a lot of those states, but this again is not atypical only in Oregon or the Portland Metro. Other questions on peers and population? Okay. So in the State of the Economy report, we always start with a look at what's happening in our region specifically, and then we broaden that to our peers. And I think what we've been tracking is perception, and that's hard to do. National headlines certainly are one way to look at that. I think what we found as the best measure of this is ULI surveys development professionals from around the country, I think over 1,000 every year, and they say rank the best development opportunities. So they take the top 80 markets around the country, and every year they track this. Again, in 2017, Portland hit their peak in terms of the national perception of the market. It was number 3 at that time and dropped back down again. But historically, again, you can see we've been in that 70th percentile of place in terms of development opportunity. That dropped drastically in the first year after the pandemic. We bounced back a little bit, but really have been hovering around the 50s and maybe in the mid 50s over the last several years. And this is indicative of a real headwind in terms of attracting development capital, both equity and debt, into our region. And this is more so than our peer regions, with the exception of Milwaukee. So if we look at Seattle, Denver, again, they're top 15 country. Minneapolis, Sacramento, still viewed as better development opportunities for us. Milwaukee is the one notable exception here. And so again, when we start thinking about our competitiveness as a region, this is a significant headwind that we're battling that aren't necessarily the case in some of our peers. In terms of jobs, this used to be called the Value of Jobs report. And so what we continue to track is jobs. And historically, we hadn't looked too much at job growth by county, as they had typically tracked pretty well. What we see today, though, is that is not the case. And so as a state and as a metro region, we have recovered all of the jobs that we lost in the pandemic and have grown, although that has really stagnated in the last, let's say, second half of last year. Clackamas County and Washington County look like the rest of the state, which is to say they're about 1 to 2% higher in terms of jobs. Multnomah County has not recovered all of the jobs that were lost in the pandemic. And this has really stagnated for the last better part of a year. And so we see very limited job growth over the last year. And in fact, over the last several months of 2023, actually some job loss. That's very different than Clark County, where there are 13% more jobs today. And if you look at the pre-pandemic trend, kind of Clark County was accelerating its growth in the several years leading up to the pandemic, and they're continuing on that trajectory. And so again, population and employment growth are not one and the same, but there are definitely some similarities. I think that's worth continuing to unpack here. Question, where are remote and hybrid jobs counted? It's a great question. I think data historically has tracked jobs in one of two ways: where the person with a job lives, or where the job is headquartered as a location. And that's what we're using here, is that headquarters location. So, on a hybrid job, yes, and we'll get more into that in terms of, if a person is in the office less than 5 days a week, their job location is still where it has historically been. I think what's more of a challenge is fully remote workers still are headquartered at the location where they were headquartered previously. And that is something that I think is more challenging, and it'll be interesting to see if data measurement starts to better capture some of those fully remote jobs, as they're now not a huge portion, as we'll see with some data, but they're not zero. I think if we're looking for early indicators of economic challenges, to me, this is one of those things we want to continue to monitor. And what that is the fact that our economic growth underperformed the US, and that is very atypical. As a region, we're the green bars. You look at that's relative to the yellow bars, which is national job growth. We have grown more rapidly in every economic expansion. When there's a downturn, we also feel that more than the national. So we are more volatile, and that's both in a good way and in a bad way in downturns. And we saw that coming out of the pandemic again, where in 2022, our job growth was faster than the US. 2023, however, was atypical in that we grew less quickly than the US. And we are tracking this through the year, and about through May or June, that wasn't the case. And the last half of the year, we really saw stagnation and in some industries, job loss, such that we are now through the end of the year of 2023, had fewer jobs gained than the US. Is that indicative of a new longer-term trend where Portland is not going to outperform the US in economic expansions? One data point is not sufficient to say that, but I think it's something we want to continue to monitor, as that has historically been one of the benefits in Oregon, is that we grow more quickly, largely related to population growth. In terms of what's happening, again, we have very different types of market conditions playing out across industry. And so when we look at where we're losing jobs, it's in information, it's in manufacturing, and it's in professional and business services. And those largely follow national trends. And so information is mostly the tech sector. Manufacturing is very volatile and jumps up and down, and that's not atypical. But if we look at over a longer period of time, manufacturing jobs have been in a decline in the US, less so in Oregon, and professional and business services are also on the decline. And so I think when we look at that, this is less than ideal. What we typically like to see is our most productive sectors growing most quickly, and that is the opposite of what's happening here. Our most productive sectors are stagnant, like construction and financial services, or on the decline. It's also particularly concentrated in office-centric jobs. And so information and business and professional services are almost exclusively office sector. And so we know we have vacancy rate issues. And then we look at 6,000 to 7,000 jobs lost in a year in office-centric industries, with little job growth in office-centric industries. That's, again, another headwind when we think about central city recovery. Government jobs, private and health services, and leisure and hospitality, I think the story there is those were places that were really challenged to hire coming out of the pandemic, when there were 2 jobs for every person looking for a job. Now this is just kind of, I think, a reversion to the mean, which is they're getting back to places that they wanted to staff levels at. And maybe we had a little bit of the opposite in tech and other sectors that were oversubscribed or labor hoarding. So a lot of this, I think, is indicative of just kind of reversions to mean rather than probably long-term trends. But again, it's something that we want to continue to monitor. The other thing that I think we historically track is what's going on in the construction industry. Here, we'll look at the city of Portland specifically, I think, as the place that's most impacted by current market conditions. In the city of Portland, most of what's built is multifamily. So here we're looking at multifamily permits issued. And you can see, again, other than 2020, we have consistently been that 3,000 to 4,000 units of multifamily permitted every year. 2023 was a big step down. And I think more troubling is if we look at the last 6 months of 2023, there were 437 permits issued. If we trend that out for a year, we're at less than 1,000 now. And so again, that used to be 1 month of permitting is what we're seeing in 6 months. And this is largely driven by broad macro market conditions, but certainly amplified by some Portland-specific stigma, as we saw in some of the ULI rankings. So this is the leading indicator of what's happening in terms of construction activity. What we see is the next step of production is under construction. And so under construction units are really what we see in terms of the pipeline. And here we can look at what's in the pipeline, and we can understand what's going to get delivered, so completed, versus how many permits are happening. What we see is the city of Portland never really recovered from those pandemic lows, but has already started to decline. The 4-county metro did see a big recovery coming out of the pandemic, and then now has seen a decline. And so we're down about 17% of units under construction as of January 2024. relative to January 2023. I think this trend is going to continue to decline as we see very few permits and lots of units being delivered. Again, this is not atypical for any other region. Seattle, I looked in the same time period, is down 17% nationally. This is down. And so multifamily, I think, is largely responsive to these macro market conditions. Okay, I see a question here that was probably a couple of slides back. How much of the 2022 to 2023 change, I think, in jobs is cyclical impact? So that was the question. I think I responded was yes, some of that was leisure and hospitality, for example, still not back to pre-pandemic levels. That's one of the cyclical natures of what we saw happening. Okay, so that's under construction. That's the last kind of quick section that we look at when we look at the Portland specific metro. I see a question on office vacancy and housing needs. We'll talk about that here in the upcoming section. Any other questions or anyone want to raise hand and unmute around what specifically we see in terms of the Portland metro? Okay. In the report, we now have a section that I'm not going to cover today in the interest of time that then looks at kind of similar performance of the Portland metro relative to our peer regions. And so we look at jobs, we look at income, we look at GDP, we look at affordability. And what we see across all of those is Portland is generally middle of the pack. And so rather than going through that detail, in the interest of time, you can go to the Metro Chamber website, or we'll post a link and you can see more detail there. But I think for us, that's generally, again, contextualization that we're not exceeding these peer regions. We're not the lowest performer, but we're generally middle of the pack. And certainly there are some opportunities for improvement across some of those metrics. I think for us, as we specifically think about the future of cities, the state of downtown and the central city is something we've been looking at for the last couple of years as a part of this report. And for some contextualization, here in Portland, we are using the city's own designation of the central city. The central city has 10 sub-districts, one of which is downtown. And so oftentimes I think people use downtown and the central city interchangeably. Here we mean very specific, discrete things. Downtown is a sub-district within our central city, and the central city is a larger area. And so when we look at some of the literature that I shared earlier, people talk about the recovery of downtowns. I think they are generally trying to measure more like the recovery of central cities rather than a downtown. Some places say central business district, CBD. Some places don't even call their downtown uptown. So for example, Charlotte calls that they call their downtown uptown. So I think for us, central city is really the geography we're most interested in studying more. And the historic ways that we've done that, I think, we look at things like office vacancy rates, office lease rates, et cetera. And so, a surprise to nobody, vacancy rates in office are up. They continue to go up. We did this report through end of year, and we've now pulled data again. And so now total vacancy is about 9 million square feet more than we had previously, or total, I should say, and more than we had at the end of the year. Vacancy rates are pushing 22% in our central city for office. So that's, again, I think, a very lagged indicator, and why we don't necessarily put a lot of weight into understanding this. Why is it a lagged indicator? Well, leases typically for commercial, for office, are signed in the, let's say, 7 to 10 year range. And so when we see a lease signed pre-pandemic, behaviors may have changed. They may not be using the space at all. They may be using it for hybrid work, but we really don't know what's happening until we see new leases being executed. And so for us, that's what we're tracking with more salience, is what's the volume of new leases? And the answer is the volume of new leases is down quite a bit from pre-pandemic, and we continue to track this every quarter. And I think what we're seeing effectively is continual decline in the number of leases that are signed. And so when we're looking at the cumulative impact, we kind of have three things that can happen, right? Someone can not renew a lease at all, so that is go fully remote, right? And that's going to increase vacancy. Someone can sign a lease, but outside of the central city, that adds to vacancy. Or people can execute a new lease where theoretically they can take more space. That happens almost never. What we see on average now is firms are taking 30% less space. And so until we have all of the leases that were signed pre-pandemic renew, we aren't really going to understand what that new baseline is. And from there, I think we can then start measure recovery. How do we do that? It's challenging. I think every broker in town is looking at this. We have some relatively simple models that do that. CoStar, for example, has a model that does this. Their forecast for office in the central city is negative absorption, so that's to say increasing vacancy through about 2027. Now, the next 18 months to 24 months is when the largest, I think, negative absorption is going to continue. And from there, at least CoStar's model is showing kind of a negative, but rapidly approaching zero. So it's really the next 2 years is where I think we're going to see the bulk of this, where office vacancy rates will continue to increase. Question, do we know the central city residential vacancy rates? Yes, we can definitely measure that. I think, multifamily is what we're largely talking about here. What we have seen is stabilized vacancy rates actually are pretty low, but as we deliver new units, that absorption in that pipeline can take a little bit of time. And so at any given moment, we've had a couple of buildings deliver recently that can increase. But if we look at the long-term stabilized vacancy rates, they're holding pretty consistent and they're generally low. So I think the biggest question is, how much does hybrid work have to do with this? And to me, it's not exactly clear what that relationship is. But I think understanding what the pattern for hybrid work is likely to be is helpful, that we can then explore how it might change or might not change. And I think the answer is very clear in the data. Return to work preferences didn't change a month ago, 6 months ago, a year ago. More like 18 to 24 months ago, we saw what is the new normal. So again, I think we have now almost 2 years of data to suggest that the percentage of days that people are going to work from home is what it is. And so if there's an expectation that through individual firms changing their policies or incentives or otherwise, it's going to be very challenging to get workers back into the office more than we see today. And it's varied across industry, but on average, we see something like 29% of days are worked from home, and that's going to continue to be the case. The researchers out of Stanford have been studying this in a couple of survey instruments they've had even pre-pandemic, and they're really the leading experts on this, and they describe this as flat as a pancake. And so again, I think for us, the key here is not all workers can work fully remote or in person. But if we look at the jobs that are able to work remote, 20% of those are fully remote, 50% of those are hybrid, and a third of those are, work in person. And so for us, I think this is what we're tracking as pretty stable at this point. And so when we're looking forward, big changes in behavior aren't likely to happen on a change from hybrid or not. What we see is people work 2 to 3 days in the office. Those 2 to 3 days are Tuesday, Wednesday, Thursday, Monday, and Friday. When we look at foot traffic or badge activity or anything else, we see, and that's pretty stable. So again, this is just one slide. I think in the future, we can do a much deeper dive into this, but as just a level setting, I think the expectation that we're going to see meaningful change in return to work behavior is not informed at all by the data. We suggest this is very stable and we shouldn't expect to see this changing. Okay, so there's a question related to office vacancy and housing needs. What is the future of office spaces? Is it assumed office vacancy rates will stabilize in the coming years? If so, when? Otherwise, when will office to residential conversions be considered feasible given the lack of potential from office rents? So I think what I would say is, unfortunately, office to residential conversion is really challenging. The city, the state, federally are all thinking about this, and we're seeing kind of an evolution of policy priorities and programs that can help with that. But what we see is nationally, there are places where some conversion is happening, and that's very specific to the stock of the buildings in terms of their architectural form, and other market conditions. But in Portland, we are seeing no examples of that today. Does that mean that I don't think there could be one or two examples without additional incentives or regulatory relief? I think you could see one or two buildings, but it's pretty unlikely you'd see more than that. Really, what we're going to need is regulatory relief, incentives, or changing market conditions. And so, again, I think this could be a topic of a larger conversation, but I think as it relates to this, that's the main impediment here. We know with near certainty, vacancy rates are going to continue to go up. Office rents aren't changing, which is a little bit counterintuitive. With less demand, you would assume rents would go down. That's not what's happening. You're just seeing more incentives. So you're seeing free rent concessions, large tenant improvement allowances, and other things, but the rents themselves don't actually go down very often or ever as it relates to market conditions. So that's the, I think, level setting. I think what we're seeing now is a hesitancy to continue to talk about pre-pandemic. And so rather than saying things like foot traffic as a leading indicator hasn't recovered, isn't necessarily helpful when we know that, for example, office and employment foot traffic is not going to recover. And so we can continue to talk about the fact that it's not going to recover, or we can try to say, let's look at visitors, let's look at residents, and let's understand, are we attracting more people into our downtowns and our central cities? How important can residential be in terms of adding to a vibrancy, a mixed use, an 18 or a 24-hour type of foot traffic? These are things that are much more productive rather than talking about a percentage of recovery, of which Portland typically is at that bottom end of those. I think for us, we're much more interested in, from a research perspective, saying, what is the recent trend? And so are we improving or not? And we can now contextualize that with our peers. What is our mix of uses? So is our mix of uses similar to our peers? Is our mix of uses consistent across our central city? And then the last question would be density, which is how much actual foot traffic do we have? Do we have enough foot traffic to sustain the amount of retail space, office space? What is the mix? Where are we getting consistent across our central city? And where do we have places that aren't seeing that level of activity of neighboring subdistricts? So those are the three lenses. We'll look at each of those for our peer regions relative to our central city, and we'll look at within our subdistricts. And to do that, we had to go and create equivalent central city regions for each of our subdistricts. So our central city is a given in Portland. It's roughly 3,000 acres, right? And it has the 10 subdistricts. For our peer regions, we had to really think about a methodology on how you could come up with something like apples to apples, because they don't always have their own self-identified central city regions. Seattle, for example, does have a downtown Seattle association. We looked at that, but ultimately chose to use this kind of consistent data approach, which is to say, let's look at the places that have the highest density of employment and then kind of create contiguous geographies across them. And what we see is the sizes of those places vary a lot across our peer regions. So we're at 3,000, that's at the highest end. Seattle, Denver, Sacramento are in that 1,500 to 2,000 acres, and Minneapolis is at 1,000. So we're, 2 to 3 times as large as most of our peer regions. So I think, again, that contextualization is important. Milwaukee is much more like we are, which is to say their employment is more geographically dispersed. They have more residential communities that are adjacent in and around their employment centers, which is much more like Portland. But I think right away we see our central city is very different than some of our peer regions. To check how accurate we are, we wanted to say, okay, we have these geographies. How much of the population lives in them? How much land area are they? And how many jobs are located in those places? Again, just for some contextualization. And we see that they're pretty consistent. Portland is kind of right in the middle in terms of the share of our population. 7% of the population of the city lives in this geography. It's 3% of the land area. Again, Milwaukee is at the high end at 6%. Most of them are 2 to 3% of the city. Jobs is really where we see Portland as an outlier. Our central city, as defined, has 70% of our jobs. Part of that is OHSU is not explicitly in our central city. South Waterfront is, but most of the OHSU jobs in South Waterfront are geographically attributed to up the hill. And so to do that, we grabbed all of the OHSU jobs just to see, okay, that's just a choice to not include those jobs, but they're really a key part of our central city. We now increase to 80% of jobs. So again, we still are on the very low end of our jobs, which is suggestive of, again, intentional strategies at the city for centers and corridors. So employment centers and corridors that are not only in our central city. We have a less geographically concentrated share of our employment in our central city than our peers. So those two distinctions, I think, are key. Our area is bigger, and even though it's bigger, we have fewer jobs relative to our peer regions. So what does that mean? I think, again, the headlines are, Portland is second to last or last in its recovery. And there's lots of flaws with those studies in terms of their geographies. We're not going to go into that necessarily today. I think the key is we saw 14% increase in foot traffic from calendar year 2023 compared to calendar year 2022. This is outperforming Milwaukee, Sacramento, and Denver, trailing Seattle and Minneapolis. And so we think about what's happening in and around our central city. This, again, is, I would describe, not atypical of what we're seeing in our peer regions. We're seeing recovery, actually recovery that's faster. I think what's more encouraging is when we go to our sub-district level, our sub-districts that had been seeing the least recovery actually outperformed. And so Lloyd, downtown, Old Town, Chinatown had been our least performing in terms of share of pre-pandemic. They all grew at 19 to 20% growth over this last calendar year, outperforming the central city. And again, West End and the Pearl District were some of our best performing geographies. And so again, they didn't have as much recovery to do, explains why they're on the low end. So again, I think this is a really helpful tool for us to get more like leading indicators of what's going on. The other thing that I think is very helpful in foot traffic data as a leading indicator is we can subset them based on whether you're a resident of a location, whether you're an employee of a location, or whether you are a visitor, which is to say you don't live or work there. You could be a visitor from the rest of the region or a tourist from out of region, and those are different nuanced data that you can get at by the visitor section. But I think, again, we've hit on employment data at this point is relatively stable. We aren't adding a lot of jobs. In fact, we're decreasing jobs in the employment sectors that are office-centric. Those behavior around return to work are fairly stable. And so that part of our regional foot traffic is not likely to change. And so really we're left with visitors and residents. And so for us, as a city, we can have a lot of say, and as a region, over both of those two factors. I think the key here is we look across our peer regions, our mix is not atypical. And so we're a little bit higher and overweighted on residents, a little bit lower weighted on visitors, but on average, our central cities look very similar to those. So I think that is very helpful to understand, our mix of what's going on is similar. Our recovery has been a little bit better, and that's a different narrative that I think we see certainly in the media. For us, though, I think what we see is across our 10 sub-districts, we have big variation in terms of the composition. And so in aggregate, employees were 30% of foot traffic, and they're now 24%. And again, I think that number is surprising to many. I think if you had said what share of employees were driving foot traffic, that answer probably for most people is way higher than 30%. But in reality, it's visitors are the largest share in any of our sub-districts. Residents vary. We have very little residential activity in some of our sub-districts, downtown and lower Albina, for example. And we have larger shares of employees. So again, just understanding what this looks like in each of our sub-districts is helpful to track in terms of recovery and also to track in terms of interventions that can get better balance. One of those ways that we can track leading indicators is building housing. And so here, the best way we can track that is what is the ratio of jobs to housing units, and knowing that housing units are going to lead and drive residential foot traffic. So we are at the lowest end of the ratio. Us and Milwaukee are about 4 jobs for every 1 housing unit. Minneapolis is at the other end at 10 to 1. Is there an optimal ratio? I would say, there's no optimal ratio, but what we see is sub-districts and central cities that have a better mix have performed better in terms of their recovery. And I think indicative of a mix of uses being more stable through uncertainty and disruptions. And so for us, 4 is our number, but really it's varied across our central city. Some of our newer mixed use neighborhoods, the Pearl, South Waterfront, are in that 1-to-1 ratio. And again, is that too low, too high? I think it's indicative of the fact that our residential neighborhoods that are predominantly residential actually are pretty balanced on a 1-to-1 basis. Our downtown is 20-to-1. And so again, I think this is more about taking downtown and trying to make it more like the Lloyd in the Central East Side, which again is not going to be 1-to-1 or even 4-to-1. It's probably taking our Lloyd and our Central East Side and making them more like our combined Central City at 4-to-1. And again, relative to our peers, this is already on the lower end of the distribution. So I think for us, as we think about mix of uses and less office-centric mono-use districts, our Central City is better positioned for that than many of our peers, although we have pockets that are out of balance within that. So that's, I think, indicative of a good tailwind as we start thinking about the new normal and the success for cities and regions. The last one is density of use. I think we think about Portland as a very walkable place, a very walkable region, largely due to our small block sizes. I think what's unclear is how does that contextualize relative to other places? And the answer is our foot traffic per acre, so here it's showing per month, is actually at the lower end of our peer regions. Does that mean that we're not a walkable, highly dense, active place? I think it's unclear. I suspect most of these are at that highest end of all places. And so, you know, Seattle might be in the 99th percentile. We might be in the 95th percentile of place, but this warrants further exploration. So I think as we start to see now the data indicators that are best for contextualization and measuring, we're going to start to see more studies out there looking into how important these things are. What I would say, though, is we see very clearly this relationship around our central city and Milwaukee Central City being the largest, having less foot traffic, and the places that have smaller central cities have more foot traffic. So again, I think it's never going to be exactly apples to apples, but there is something to be said, I think, into, well, are the places that are smaller getting more density because of that? And so to check that, we said, well, let's look at our central city subdistricts. Are our most dense subdistricts, which are downtown and the West End, how do they compare? And the answer is they're still well below certainly Seattle. They're closer in alignment to Minneapolis and Denver in that 3,500 trips per month per acre range. So again, our most dense places are doing okay, but on average, we have many subdistricts that simply aren't at that level of our peer regions. We have a question. How does public transit play into the foot traffic in this comparison? And so the data show, if we're looking at foot traffic and kind of trying to understand relationships, public transportation use as a share of commutes is negatively related to foot traffic recovery. So that is to say the places that have higher shares of people, Portland is, I think, number 3 in the country of public transportation commutes into their central city, have a lower recovery. Why is that the case? I think it's an interesting question. The survey data suggests that people aren't less interested in public transportation today. We see ridership is down. Is that a question of flexibility, level of service being cut in many markets? I think there's a lot more study to be done here. But in terms of the actual mechanics of it, it's using cell phone data. And so if you have your cell phone and you don't opt out of geographic tracking, all those apps are then packaging and selling this up. So if you're taking public transportation in, it would know that you live, let's say, somewhere else and work somewhere else. So it's able to theoretically understand those differences. But in terms of how specifically important is public transportation in terms of recovery, I think the early studies are suggestive of, again, that's a headwind, which is more of a problem for us as a region, being a national leader in investments in public transportation. Okay, let me pause there and see if there are any additional questions on downtown central city specific issues around foot traffic, office vacancy, contextualization with our peers, and then we'll quickly jump into this last takeaway section and get out of here in roughly an hour or so. But if people have to leave, feel free to leave at any time. Okay. So I think what we started with was this hypothesis of, are we entering a place where the Rust Belt is an appropriate comparison for us, which is to say they've had population stagnation. And so I think to gauge the level of seriousness of this, the state now is producing a report called Zero Migration, a Demographic Alternative Scenario. One of the state economists last year said if we had negative population growth in 2023, which we, according to the data, did have, that's a 5-alarm fire. That's not a one-year aberration. That's something they're actively continuing to track. Part of that is now scenario planning for what a future with zero migration might look like for Oregon. And I think the takeaway here is population growth is the main reason Oregon's economy outperforms a typical state over time. What we typically have is an influx of young working age residents that allow local businesses to hire and expand at a faster rate. And I think conversely, we see the opposite of that happening. So again, when we looked at that one chart showing right underperforming, and now we have less population, this is kind of leading into that fact that our economy isn't able to expand as quickly as it historically has if we don't have that strong influx of immigration as we historically have. And it's suggestive of, what does that look like for a long-term trajectory for the state? And so the state economist's office in this report has looked at stagnation, and stagnation isn't outright decline. It's just saying, are you getting your share of the US average, yes or no? And so if you are growing less quickly than the US, you're stagnating. And so Michigan and Ohio, I think, are the two classic examples of this. Their population has been stagnating since the 1950s and 60s and has continued to decline. California is the opposite of that, which is they have been growing faster than the US up until about the last decade, at which point they are now stagnating. And so another, I think, interesting example is Massachusetts. Isn't one that people, I think, would think of as population having stagnated, but it has. And so again, what you see here are very different compositions of states that are all seeing stagnation in terms of population growth. The timing of that differs. For Oregon, I think the question is, we haven't been in that place. Are we now entering that place? The last 3 to 4 years are suggesting that yes, we are in that place. The forecast contemplates growth. Growth, though, at a lower rate than the US average would mean we are in a place of population stagnation. I think that's what this contemplation is trying to look at from the state's perspective of what does that mean? We are largely a income tax funded state. And so for the state, they're most interested in looking at per capita income as that measure of revenue. And I think we see two very different paths. One, Ohio and Michigan had per capita incomes higher than the US average in the 1950s and have been consistently declining. Oregon tracked them almost perfectly in terms of their decline through about 2010. And then we saw an increase. And this has been an intentional, I think, strategy at the state level, at local, regional economic development of how do we attract higher wage, higher productivity jobs. And I think now, up until the last year or so, you really can see that clearly in the data that we have deviated from that historic path. California and Massachusetts look nothing like that, though. They have had growing per capita income relative to the US for the last several decades, even though they've had economic population stagnation. And so I think this is suggestive of population stagnation isn't, let's say, putting you on the only path towards also economic stagnation. There is another path. I think what we are now seeing, though, is what is the cost of that? How does that impact disproportionately households across the income continuation? What does that mean from a race, ethnicity standpoint? How do we challenge that highly productive but yet unaffordable outcomes that we see in places like California and Oregon, or California, Massachusetts? And what does that suggest for the future of Oregon and our region? Is there a different way where we can find an appropriate balance? So I think, again, this is just the start of looking at some contextualization of what the new normal looks like. And I think lessons learned from other regions is always a helpful place to start. So with that, I think we're right at an hour. Really appreciate your time and questions we've been kicking back and forth so far. If people want to stick around for other questions, happy to field those now. Otherwise, I'll return you back to the rest of your afternoon. And thanks for coming in what is the first of hopefully many more series in terms of the future of cities. Looking forward to continuing that with more of my colleagues at ECHO and other invited guests as well.